Most people treat their tax refund like free money. A quick vacation, a new iPhone, maybe a few impulse Amazon purchases, and within weeks it's gone. But what if this year could be different? What if the average tax refund, around $3,000 to $4,000 for many Americans, could become the seed that grows into $10,000 or more? Not through gambling, crypto hype, or chasing meme stocks, but through simple, smart investing strategies that wealthy people quietly use every year. Because the truth is, your tax refund isn't just money, it's leverage. And if you understand how to use leverage correctly, you can completely change your financial future with one decision. In this video, we're going to break down exactly how an ordinary tax refund can realistically turn into $10,000, even if you're starting with zero investing experience, no finance degree, and no huge income. We'll talk about the mindset shift that separates consumers from investors, the exact investment vehicles that historically build wealth, how compounding really works, the mistakes that destroy returns, and the step-by-step approach that could make your next refund one of the smartest financial decisions of your life. Let's start with something most people never realize. The IRS refund system accidentally creates one of the best investing opportunities for middle-class Americans. Think about it. A tax refund usually arrives as a lump sum. And psychologically, lump sums are powerful because they feel separate from normal income. Your paycheck already has obligations attached to it. Rent, utilities, groceries, car payments, insurance. But a refund feels extra. It feels available. That's why so many people spend it emotionally instead of strategically. Retailers know this. Car dealerships know this. Credit card companies know this. Every year around tax season, advertisements explode because businesses understand that millions of Americans suddenly have access to cash they normally wouldn't hold at one time. But wealthy people see lump sums differently. They see them as assets capable of producing future cash flow. That single shift in thinking changes everything. Imagine two people receiving the same $3,000 refund. One person buys a luxury watch and upgrades their television. 6 months later, the money is gone, and the financial situation remains exactly the same. The second person invests that refund into appreciating assets and continues adding small monthly contributions afterward. 5 to 10 years later, that decision can create tens of thousands of dollars in wealth. Same refund, different outcome. That's the power of financial behavior. Now, before we go deeper, let's clear up a major misconception. Turning a tax refund into $10,000 is absolutely possible, but it usually doesn't happen overnight. Smart investing is not about getting rich next month. It's about creating a system where money starts working harder than you do. And historically, the most reliable wealth-building machine in America has been the stock market. Despite recessions, political drama, inflation, and crashes, the S&P 500 has averaged roughly around 10% annual returns over long periods of time. That means businesses collectively continue growing, innovating, and generating profits over decades. When you invest in broad index funds, you're not betting on one company. You're buying ownership in the American economy itself. This is where compounding enters the conversation, and honestly, compounding feels almost unreal when you first understand it. Let's say you receive a $4,000 refund and invest it into a low-cost S&P 500 index fund through a Roth IRA. If that investment earns an average annual return of 10% and you continue adding just $200 per month afterward, you're not just building savings. Your money starts generating returns, and then those returns begin generating their own returns. That's the magic. The first few years feel slow, almost boring, but eventually, the growth curve accelerates dramatically. By staying consistent, many investors can cross $10,000 far faster than they expect. Not because they discovered some secret Wall Street trick, but because they finally gave compounding enough time to work. The Roth IRA deserves special attention here because it's one of the greatest wealth-building tools available to average Americans. Unlike a traditional brokerage account, qualified withdrawals from a Roth IRA are tax-free. Think about how insane that really is. If your investments grow massively over decades, you can potentially withdraw those gains without owing federal taxes. That's incredibly powerful. And yet millions of Americans either don't use a Roth IRA at all or misunderstand how valuable it can become. If you qualify based on IRS income limits, using your refund to fund a Roth IRA could be one of the smartest financial moves available. Now here's where many people make a critical mistake. They assume investing means picking individual stocks. They imagine finance experts staring at multiple monitors predicting market moves every day. But historically, even professional fund managers struggle to consistently beat simple index funds. That's why legendary investors like Warren Buffett have repeatedly recommended low-cost index investing for ordinary people, because simplicity often outperforms complexity in the long run. A broad market ETF tracking the S&P 500 gives you exposure to hundreds of major companies across multiple sectors: technology, healthcare, energy, finance, consumer goods. Instead of trying to guess tomorrow's winner, you participate in long-term economic growth itself. Let's make this practical. Suppose someone receives a $3,500 refund. Instead of spending it immediately, they divide it strategically. Maybe $2,500 goes into a Roth IRA invested in an S&P 500 ETF. Another $500 becomes an emergency fund buffer in a high-yield savings account. The remaining $500 pays down high-interest credit card debt with a 24% APR. Suddenly, every every dollar has a job. One part builds wealth. One part protects against emergencies. One part eliminates financial drag. That's how financially intelligent people think about money. They assign purpose before spending emotionally. Debt is important to discuss because many Americans unknowingly lose wealth faster than they can build it. If your credit cards charge 25% interest, paying that debt off is effectively generating a guaranteed 25% return. Very few investments can consistently beat that. This is why smart investing is not only about buying assets, it's also about removing liabilities that quietly drain your financial future every month. Your FICO score improves when debt utilization drops. Lower debt can reduce stress, improve borrowing terms, and create more financial flexibility later. Now let's talk about one of the most underestimated factors in wealth building: consistency. People obsess over finding the perfect stock, but consistent contributions matter far more than perfect timing. There's a famous saying in investing: time in the market beats timing the market, and history supports this over and over again. Many people stay on the sidelines waiting for the perfect moment to invest, but markets are unpredictable short-term. Long-term, however, economic growth has historically rewarded patient investors. Think about the people who invested during uncertain periods. After the 2008 financial crisis, during the COVID crash, or during inflation fears. At the time, every headline sounded terrifying, but investors who stayed consistent often saw massive recoveries afterward. Emotional reactions destroy more wealth than market crashes themselves. Fear causes people to sell low. Greed causes people to buy high. Discipline is what separates successful investors from emotional gamblers. And this is where automation becomes incredibly powerful. Imagine setting up automatic monthly investments after using your tax refund as a starting point. Maybe $100 a week goes directly into your investment account before you even see it. Suddenly, investing stops relying on motivation. It becomes a habit. Wealthy people automate wealth building because automation removes emotional decision-making. There's also an important psychological shift that happens once you begin investing. You stop viewing yourself purely as a worker exchanging time for money. You begin seeing yourself as an owner. Every share of stock represents ownership in businesses generating revenue every second of the day. While you sleep, companies continue operating. Employees continue working. Products continue selling. That's why investing is fundamentally different from saving alone. Savings preserve money. Investments grow money. Some viewers might wonder whether real estate should be part of this conversation. And honestly, real estate can absolutely build wealth. But for many beginners, the stock market offers a lower barrier to entry, higher liquidity, and far less complexity. Buying property involves maintenance, taxes, insurance, financing, closing costs, and sometimes difficult tenants. Meanwhile, investing in index funds can happen from your phone within minutes. That accessibility matters because the best investment strategy is often the one you'll actually stick with consistently. Another powerful option involves using your tax refund to invest in yourself. This sounds cliché until you realize how often skill development dramatically increases income potential. Maybe your refund pays for a certification, a digital marketing course, coding education, video editing training, or learning AI automation tools. If those skills increase your income by even a few $1,000s annually, the long-term return could dwarf many traditional investments. Human capital is still one of the highest return assets available. But here's the key distinction. Smart self-investment focuses on skills with clear market demand. Too many people spend money on motivational content without developing monetizable abilities. The goal is acquiring skills that either increase earning power, improve career opportunities, or create scalable income streams. That's real investing. Let's also address risk because every investment carries some level of uncertainty. The mistake beginners make is assuming risk means volatility alone. True financial risk often comes from not investing at all. Inflation quietly erodes purchasing power every year. $1,000 sitting idle gradually buys less over time. Meanwhile, diversified investments historically outpace inflation across long periods. So the real question becomes, what level of risk are you accepting by staying stagnant financially? This is especially important in today's economy. Housing costs continue rising. Healthcare expenses increase. Retirement becomes more expensive. Social security uncertainty creates concern for younger generations. Depending solely on earned income is becoming increasingly dangerous. Multiple income streams and appreciating assets matter more now than ever before. And this is exactly why your tax refund matters so much. Because for many Americans, it represents rare access to investable capital. A chance to break out of pure survival mode. A chance to plant a financial seed instead of temporarily consuming the entire harvest. Now imagine this scenario. Two friends receive similar refunds at age 25. One spends it every year. The other invests each refund annually while adding modest monthly contributions. By age 45, the difference between them may not be thousands. It could be hundreds of thousands. That gap doesn't happen because one person worked harder. It happens because one person understood compounding earlier. The fascinating thing about wealth is that it often grows invisibly at first. Early investing feels unrewarding because the numbers look small. But eventually, growth begins accelerating. Your portfolio starts generating gains larger than your original contributions. That's when investing transforms from theory into reality. And here's another critical lesson many people learn too late. Lifestyle inflation quietly destroys financial progress. As income rises, spending often rises equally. Bigger apartment, more expensive car, luxury subscriptions, designer purchases. None of those things are inherently bad, but uncontrolled lifestyle inflation prevents capital accumulation. The people who build serious wealth often maintain intentional spending habits long after their income increases. This doesn't mean never enjoying life. Smart finance is not about deprivation. It's about balance and intentionality. You can absolutely enjoy your money while still building your future. The problem occurs when consumption becomes automatic and investing becomes optional. Financially successful people reverse that equation. Investing becomes automatic. Excessive consumption becomes selective. There's also a massive difference between looking wealthy and being wealthy. Social media has blurred that line dramatically. Expensive vacations, luxury watches, designer brands, and financed sports cars create the illusion of financial success. But actual wealth usually looks quieter. Investment accounts, retirement contributions, business ownership, appreciating assets, cash flow. Financial freedom is often invisible. And freedom is really the ultimate goal here. Investing is not only about numbers on a screen. It's about creating choices. The choice to leave a toxic job. The choice to retire earlier. The choice to help family members. The choice to survive emergencies without panic. Money itself is just a tool. Freedom is the real objective. Now let's talk briefly about taxes, because intelligent investors understand tax efficiency. If your employer offers a 401k match, that's essentially free money. Ignoring an employer match is like rejecting part of your compensation package. Combining a 401k strategy with a Roth IRA can create powerful retirement diversification. Tax-deferred growth through a traditional 401k. Tax-free withdrawals through a Roth IRA. Those details matter over decades. And if you're younger watching this, understand something important. Time is your greatest asset. Someone investing at 22 has an enormous advantage over someone starting at 40, even if the older investor contributes more money initially. Compounding rewards time aggressively. Every decade matters. But if you're older, don't misunderstand this point. Starting later is still infinitely better than never starting at all. Too many people avoid investing because they feel behind. But financial improvement does not require perfection. It requires action. Small, consistent decisions repeated over time can still produce life-changing outcomes. One of the smartest things you can do with your tax refund is create momentum. Momentum matters psychologically. Once you see your investment account growing, you begin thinking differently about money. You become more aware of unnecessary spending, more focused on future opportunities, more intentional financially. Investing changes behavior because it changes identity. You stop asking, what can I buy today, and start asking, what can this money become tomorrow? And that single question can completely alter your financial trajectory. So can your tax refund really become $10,000? Absolutely. But not through shortcuts, not through hype, not through overnight miracles. It happens through disciplined investing, consistent contributions, intelligent tax strategies, debt management, and patience. The people who quietly build wealth are rarely the loudest people online. They're usually the ones making steady, rational decisions year after year while everyone else chases instant gratification. Your next refund can disappear in a month, or it can become the foundation of future financial freedom. That decision is entirely yours, because every dollar you spend today has an invisible future value attached to it. And once you truly understand that concept, you stop seeing money the same way ever again.